Welcome to the deep dive. Today we're zeroing in on a financial practice that is basically designed to lie. It's called circular trading.
hmm
And this isn't just about bending the rules a little. It's a coordinated fraudulent scheme. The whole point is to create an illusion of market interest.
Right. And it's one of those classic manipulation tactics. It's so critical for anyone in the market to understand because it really targets our most basic instinct as investors.
Which is what? Following the crowd.
Exactly. Following the crowd, circular trading creates this, vibrant, high volume environment where in reality there's nothing there, just stale demand.
So our mission today is to give you, the learner, a really quick but thorough understanding of how this all works.
Mm.
We're going to define what circular trading is, look at the mechanics, and, explain why spotting these red flags is so crucial.
Yeah, we're going to strip away the jargon and just focus on the deceit itself. I mean, if you know how the engine of the fraud works, you can spot the smoke long before you get caught up in it.
Okay, let's unpack this then. The really fascinating part and the deeply problematic part is that this entire operation is just. It's a performance. It's all prearranged.
It is. It generates a ton of data points, these trades, but with zero actual economic change.
So let's start with a definition. What is it operationally?
Okay, so circular trading at its core involves a broker placing sell orders. But, and this is the key part, they already know that matching buy orders are lined up and ready to go.
Matching how? Like exactly.
Exactly. Same number of shares, often at the very same price. It's a closed loop, so the trade is basically guaranteed to happen.
And that's what separates it from a real trade, where you've got buyers and sellers meeting in the market trying to find the best price.
Precisely. In circular trading, the price is almost secondary. It's just about getting the trade done. But the real reason this is fraud, the absolute defining feature, is that there is no change in the beneficial ownership of the stock.
Okay, wait, let's dig into that. Beneficial ownership. Why is that the litmus test?
Yeah.
Because from the outside, it looks like a trade happened. The shares moved, the volume counter went up.
Right. But when you do a real trade, you're transferring the economic rights, the dividends, the voting rights, the potential for profit from one person to another completely separate person.
I see.
In circular trading, the people on the buy side and the sell side are either the same person using different accounts, or they're a tight-knit group working together, so the shares just go in a circle between them. The real ownership never actually leaves that initial group of conspirators.
It's the illusion of liquidity. So they're paying commissions, moving this stock around just to make noise. What are the specific goals here? Why bother?
They've usually got three main objectives. First, and this is the most obvious one, they want to artificially inflate the trading volume. High volume makes a stock look exciting.
Right, it gets on all the scanners.
Second, they're trying to keep the share price at a certain level, or maybe even push it up. And third, and this is the most important part, they are trying to create the illusion of intense, genuine market interest. They want to lure in real investors.
And because this is all about deception, the legal status is pretty clear, I assume.
Oh, absolutely. It's straight up market manipulation. It's illegal in basically every regulated market in the world. They treat it very, very seriously because if you can't trust the trading volume, then what can you trust?
Yeah, it undermines the whole system.
The whole thing.
Okay, so let's get into the mechanics. This isn't something one person can just do on their own, is it?
Yeah.
How does this conspiracy, this group, actually pull it off?
No, it takes a lot of planning and a network of accounts. You'll have a small, organized group, the manipulators, and they'll set up several different brokerage accounts, maybe under shell companies or, other people's names.
And they use those accounts to just trade a specific stock back and forth between themselves.
Over and over again. And to make sure the orders match perfectly, they're coordinating outside the market. They've already agreed on the price and the number of shares before they even place the orders.
So there's none of that natural price discovery. A real buyer is trying to get the lowest price. A real seller wants the highest. But here,
the goal is just execution. The price doesn't really matter because they're essentially trading with themselves. The goal is to create volume.
can you give us an example?
Sure. Imagine account A puts in a sell order for 100,000 shares at, say, $5. At the same instant, account B, which is run by the same group, puts in a buy order for 100,000 shares at $5.
Boom. The trade executes.
Right. And just like that, you've generated 100,000 in volume, and the price is holding steady at $5. Then they just do it again. Account B sells to account C, C sells back to A, Round and round it goes.
And that cycle is what shows up on the charts, on the volume indicators.
Hmm.
And if I'm an outside investor, I just see these huge blocks of shares moving, and I think, wow, something big must be happening.
Someone knows something I don't. And that is the trap. That perceived demand, which is totally fabricated, it convinces real, unsuspecting investors to buy in.
They think it's a sign of good news coming, or that big institutions are piling in.
And the manipulators are basically just spending a little bit on brokerage fees to trick people into pouring in massive amounts of real money.
So they might spend a few $1,000s in commissions to cycle the shares around, just to get enough real buyers to come in and push the price from, say, $5 up to 7 or 8.
That's the entire profit mechanism. The price goes up purely because external money believed the lie. The stock price is just inflated through fraud, not because the company is actually doing any better.
So let's talk about where this stuff thrives. It creates this false sense of activity, which, can really mess with a stock's performance. Who's most likely to fall for this, and what kind of stocks are we talking about?
Well, the sources are pretty clear that day traders are extremely vulnerable. But it's not just them. Even seasoned professionals who rely on quantitative signals can get caught.
How so?
Well, think about it. If you have a trading algorithm that's programmed to flag any stock with, say, a 500% jump in volume, it's going to flag this. The algorithm doesn't know who is trading. It just sees the numbers.
So the manipulators are basically gaming the algorithms.
They are. And when you look at the types of stocks, it's not surprising that things like IPOs, initial public offerings, and penny stocks are at the top of the list.
Okay, why those two in particular?
Well, with an IPO, the stock has no trading history. There's no benchmark for what normal volume looks like, so any activity seems huge. The goal there is to generate immediate buzz and set a high opening price.
That makes a lot of sense. With a big, established company, a sudden spike in volume might look suspicious. But with a brand new stock, it just looks like momentum.
Exactly. Now, for penny stocks, the vulnerability is a bit different. It's usually because they have low liquidity and not many shares available to trade a low float. So a manipulator can control a huge percentage of the daily volume with not a lot of capital.
They can make a tiny, obscure stock look like the hottest thing on the market.
They create that hot commodity feel in a place where the market is already kind of murky.
And this brings us back to the day traders. And this is a really important detail for you, our listener, to grasp. Day traders live and die by those short-term moves.
They do. They rely on things they can see right now. Volume, volatility, the order book to make split-second decisions.
So when they see a stock pop up on their high-volume scanner, what do they think?
They see a train leaving the station, and they feel like they have to jump on. That circular trading is creating the exact signal that their whole strategy relies on. They buy in thinking they're riding a wave up.
But really, they're just giving the skeevers an opportunity to sell. They're providing the exit liquidity.
That's it, exactly. And the danger is that it's not just one big trade. The manipulators create this facade of sustained demand. The shares are moving fast, but it's all internal.
So how do regulators even fight this? It seems really hard to spot from the outside.
It is, but they have gotten a lot more sophisticated. They use their own algorithms now to look for what they call wash trading patterns.
So they're not just looking at high volume. They're looking for, what, a signature?
A signature of collusion, yeah. They look for accounts that seem to always trade with each other, or stocks where the price stays weirdly fixed for a long time despite high volume. It's a constant arms race, but they are looking.
But it still happens.
It still happens. The best defense is always going to be your own skepticism. If you see a huge volume spike with absolutely no news to explain it, you have to be suspicious.
Which brings us to the inevitable aftermath. A scheme like this, built on a lie, can't last forever. So what happens when the whole thing collapses?
Well, once the manipulators feel they've pushed the price up as high as it'll go with all that outside money, they start the dump phase. They stop the circular trading.
And start selling for real.
And start selling everything they hold into the very market demand they just created. This flood of real shares for sale causes the price to just crash.
And the fall is dramatic, right?
Yeah.
Because that artificial support is just gone in an instant.
It vanishes. So the investors who bought in at the peak, say at $7, they suddenly realize there's no real demand there, and the stock plummets back to its true value, maybe $2 or $3.
So people lose a lot of money.
Significant financial losses for anyone who fell for it. And beyond that, it really damages the market's integrity. It destroys trust in the data, and that makes everyone more hesitant to invest, which ultimately hurts honest companies trying to raise capital.
So to sort of sum it all up, the key takeaway is that circular trading is deceptive, it's illegal, and its only purpose is to trick outside investors by creating a fake reality.
And understanding that this can happen is just vital for everyone. Knowing that volume can be completely manufactured forces you to look at all market data with a healthy dose of skepticism. And that's the foundation of making good decisions.
It's all about generating volume without any substance, a big noisy show to hide the fact that there's nothing really there.
Right. And that leads us to a final thought for you to take away from this.
Okay.
So we know that so many traders and even trading systems rely heavily on high volume as a key indicator. Giving that and knowing that it can be faked, what else do you have to look for? What other metrics, what fundamental analysis do you need to do to tell the difference between real demand and a total fabrication?
If the volume is high but there's no news, no reason for it.
What's really driving it, you have to look past the ticker. You have to demand a genuine reason.
That's a critical question for navigating the markets today. Thank you for joining us for this deep dive.
Thanks for having me.